Ever wondered how the Fed's interest rate cut impacts the earnings of big banks? Today, we dive into this intriguing subject. Recently, the Federal Reserve announced another interest rate cut, a move that sends ripples across the financial landscape. This decision is more than just a headline. It's a complex financial maneuver with far-reaching implications. But how exactly does it affect the earnings of our nation's largest financial institutions? Stick around to find out how this seemingly complex financial maneuver affects big bank earnings. First, grasp the concept of interest rates. Interest rates are, quite simply, the cost of borrowing money. When you take out a loan, the lender charges you a percentage of the amount borrowed as a fee for lending you the funds. This fee is what we commonly refer to as the interest rate. Interest rates play a pivotal role in our economy. They influence how much individuals save, how much they borrow, and ultimately, how much they spend. When interest rates are high, people are incentivized to save more and borrow less, thereby reducing their spending. Conversely, when interest rates are low, people tend to save less, borrow more, and spend more, stimulating economic growth. Now let's talk about the Federal Reserve, or the Fed as it's commonly known. The Fed is the central banking system of the United States, and its main job is to keep the economy stable. One of the key tools it uses to do this is the ability to set the federal funds rate, which is the interest rate banks charge each other for short-term loans. This rate indirectly affects the interest rates you and I pay on our loans and earn on our savings. When the economy is booming, the Fed might raise the federal funds rate to keep inflation in check. In contrast, when the economy is struggling, the Fed might cut the federal funds rate to stimulate economic activity. A change in interest rates can create a ripple effect across the entire economy. For instance, a rise in interest rates can make borrowing more expensive, causing both individuals and businesses to cut back on spending. This can slow economic growth. On the other hand, a cut in interest rates can make borrowing cheaper, encouraging more spending and potentially speeding up economic growth. Now that we understand interest rates, let's dive into how a cut in these rates can impact big banks. Interest rate cuts can have a significant impact on big banks. This impact is often seen in their profits, which can fluctuate depending on the current interest rate. Let's break it down a bit to understand this better. When interest rates are slashed, it typically means that the cost of borrowing money becomes cheaper. This might seem like a good thing on the surface, but for big banks, it can lead to a decrease in what is known as net interest income. So, what exactly is net interest income? Simply put, it's the difference between the interest income generated by banks from the loans they provide and the interest they pay out to their depositors. When the interest rates are cut, the spread between these two narrows, resulting in lower net interest income for banks. But wait, it isn't all doom and gloom for the big banks. Lower interest rates can also lead to increased borrowing and spending. When it becomes less costly to borrow, consumers and businesses are more likely to take out loans for everything from buying a new car to expanding their business operations. This increased borrowing can result in a boost to other areas of bank revenues, such as fees from loan origination and servicing. In addition, lower interest rates can stimulate economic activity by making it cheaper for businesses to finance their operations. This can lead to increased demand for other banking services, such as treasury and cash management, which can also bolster bank revenues. So, while lower interest rates can reduce the net interest income for big banks, they can also stimulate borrowing and economic activity, which can boost other areas of bank revenues. This is why interest rate cuts are often seen as a double-edged sword for banks. On one hand, they can lead to decreased income from interest, but on the other hand, they can stimulate economic activity and lead to increased revenues in other areas. To sum up, interest rate cuts can be a double-edged sword for big banks, simultaneously reducing some sources of income and boosting others. It's a delicate balance that banks need to navigate carefully, adjusting their strategies and offerings in response to shifts in the interest rate landscape. The implications of interest rate cuts extend beyond immediate bank earnings. While it's easy to focus on the immediate impact on big banks, it's crucial to appreciate the broader economic implications of interest rate cuts. You see, these reductions are not made in isolation. They're part of a larger, more intricate economic strategy intended to stimulate economic growth. So, how does this work? Well, lower interest rates make borrowing more attractive. This encourages both businesses and individuals to take out loans, which they can use to invest, expand operations, or simply increase their spending. This heightened activity then fuels the economy, creating a ripple effect of growth and prosperity. But what does this mean for the banks? While the lower rates may initially shrink their profit margins, this economic growth can indirectly benefit them in the long run. More loans mean more customers. More customers mean more opportunities for banks to offer other services and products. In addition, a thriving economy often leads to increased deposits as individuals and businesses earn more. And remember, banks can use these deposits to fund more loans and generate income. So, as the economy grows, so do the opportunities for banks to expand their services, diversify their income streams, and ultimately boost their earnings. So, while interest rate cuts can have mixed effects on bank earnings in the short term, they can contribute to economic growth that benefits banks in the long run. So, what's the takeaway from all this? Well, we've delved into the intricacies of interest rates, their cuts, and the impact on big bank earnings. We've seen that while a reduction in interest rates can potentially diminish some income sources for banks, it's not entirely a gloomy forecast. These cuts can stimulate economic growth, which in turn creates a more favorable environment for banks to thrive. Lower rates can encourage borrowing, spending, and potentially a healthier economy. This can result in increased loan volumes for banks, counterbalancing the initial losses from the rate cuts. So, it's a bit of a balancing act, isn't it? The financial world is seldom black and white, and these rate cuts are no exception. They illustrate the ever-dynamic nature of our economy, where changes are not just challenges but potential opportunities. Remember, the world of finance is complex and interconnected. A change in one area can have far-reaching effects elsewhere.